I am not a financial advisor. I am not responsible for your losses, only your profits. Why am I going to lead off with the stock market? Well, you ever hear the saying stocks and bonds? And the reason they say it like that is because money typically flows between those two markets. You buy stocks to try and make money, and you buy bonds, which include both treasuries and mortgage-backed securities, not to lose money.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Back at the desk here Monday night, gonna knock this thing out for you real quick. Hopefully. We got the NBA annual coming up in Denver. It's the Super Bowl of our industry. Pretty awesome seeing this. 3,500 people registered, plus 500 for the Women's Empowerment event. I saw that from Greg and Marsha's video today. I thought that was a pretty cool video. Look around for it on LinkedIn. Okay, it's a light macro week, but heavy Q3 earnings. And so I am not a financial advisor. I am not responsible for your losses, only your profits. Why am I going to lead off with the stock market? Well, you ever hear the saying stocks and bonds? And the reason they say it like that is because money typically flows between those two markets. You buy stocks to try and make money, and you buy bonds, which include both treasuries and mortgage-backed securities, not to lose money. So when you're talking about the flow of money, there's a lot of flow that goes in between those two different types of equity classes and asset classes. So let me just say, there is something that is called volatility, and that is how quickly, rates or stock price or oil price or whatever the case would be, how quickly it could go up or down. And there are actually indices that measure this stuff. So the VIX is one, the volatility index, which measures basically the volatility of the stock market. Kind of look at like how many people are buying, put versus calls, betting on markets to go up or down. They'll look at options. But there's also one for the bond market, and it's called the MOVE, M-O-V-E. You can actually look up, so VIX and M-O-V-E. Well, the MOVE is at the highest it's been all year. That means the bond market, okay, this is the Merrill Lynch Options Volatility Expectation. I know it's a mouthful, but you get the point. This is the highest volatility level of the year. And I watched our good friends over at MBS Highway on their daily podcast, and what they noticed was in 2022 and 2023, and looking like again this year, that the peak of the 10-year Treasury yield of each of those respective years was in October. Well, here we are in October, and we just touched 420 today. I'm just checking out the MBS Highway website right now. We're down from 4.1956. This overnight trading is 4.1877. What's going on? Why do we go 50 basis points up in 10-year Treasury yield when the Fed cut the Fed funds rate 50 basis points down? Because there's a lot of uncertainty. There is a tremendous amount of uncertainty, and it's showing up in volatility, and bond traders are demanding more yield because they don't know what to expect from many different reasons, right? Is the economy overheated? How are jobs doing? What's going on with inflation? Are we going to have World War III? What's going on in Russia? What's going on in the Middle East? What's going on with oil? And so what's going on with the presidential election? How about that? So who's going to be our president? What's the balance of power here at home? Senate, Congress, House, is it going to be lopsided one way or the other? Is it a sweep? We have divided Congress. Who's going to be the White House? So that is all sweeping into this time of the year. And seasonally, this is kind of a volatile time. I pay for a ton of subscription services, stocks, so you don't have to read all this information. Let me just say, I'm shocked that the stock market is setting all-time highs again this week. NVIDIA, all-time high again today if you're a stock trader. Just this far off from overtaking the market cap size of Apple, which just released their own AI through their installed base of iPhone users. So, I love trying to predict the future here. I've been wrong numerous times, but the flow of money between stocks and bonds is very interesting. This yield that's being demanded, that's working mortgage interest rates up right now, is a direct reflection of that volatility and uncertainty. And I've been talking about certainty versus uncertainty all the time. So let me confuse you even more with some data and some statistics, okay? So owner's equivalent rent. Rent is rent inflation going up? Is it going down? There's something called the rent gap, which is basically what existing renters pay versus what a new renter pays. Now, we know that data lags a year back, but I did some research for one of my stock research articles, and it said the rent gap, pre-pandemic was about 1%. Okay, so if you kept your lease, and then if you went out and found a new, place to go rent, you're likely to have a 1% increase in rent. So right now, as of last month, the gap is hovering around 5.5%. So if you go sign a new lease as a renter, you can expect to pay more. That's inflationary. And that's part of why we're seeing maybe a higher CPI with the owner equivalent rent. We've got PCE coming out next week, personal consumption expenditure, which is a big deal. That's the Fed's preferred inflation measure. So the bond market, are they worried about inflation? Did we cut too soon? Are we going to overstimulate too early the economy? This economy, I talk about this, some haves and some have-nots. I've been talking about this theme for years, and we're looking at it with $150 trillion of net worth in this country of wealth. 75 trillion of it is the boomer generation. So 5% of America lives paycheck to paycheck. And, there's a lot of stats about that. And rent is one of those tough things where, if you're not a homeowner, you don't have wealth, at least on paper, from equity, you're renting. You may more likely be living paycheck to paycheck. Your income is not keeping up with inflation. There was construction data, new home sales data, housing starts data, multifamily, okay, that's pretty much anything with 5 units or more. Think like, complexes, buildings, high rises. Those starts are down over 15% year over year. So obviously with money being so expensive because the Fed has got the rate so high and borrowing costs are expensive, commercial developers are not building multifamily. And again, that helps to create this rent gap because there's less options for people to go, which, by the way, just not for nothing, I don't know the exact number and I'm not making a political statement, but there's 11 million new people in our country. So where are they living? And so that obviously puts upward inflation pressure on new rents. The peak is 11%. So on the rent gap. So we're down from the peak, but we still have that gap. Okay. 15.7% is the multifamily housing start number that's down. Okay. That's that number. All right. Retail sales. Okay. We talk about retail sales. That is another piece of pressure. You've got your housing components that make up some of the inflation. But then, of course, what about prices? When retail sales went up last Thursday on the retail sales report, we obviously saw some upward pressure. So you dig into those numbers and you see what that means. Okay, 0.4% is what it was. Now, excluding autos and gas stations, sales were up 0.7% for the month. That's 3.7% annualized. Okay, the economists were looking for a 0.1% jump month over month. So 10 out of 13 categories all showed inflationary and sales being up. Okay, upward pressure. Now, there's something called a control group in there, right? Where you basically take out things like car sales, gas stations, and building materials. And the control group within the retail sales was up 6.4%. So that's a lot. Okay, that's a lot. And the last 3 months ended in September. Okay, so let's go back to rent. Okay, there is a humongous report that comes out once a year. It's called the American Community Survey. Okay, so it's like, they're just now getting data out to us from the Bureau of Labor Statistics on this American Community Survey for 2023. So, but it's very good data. But I'll give the quick cliff notes. The Joint Center for Housing Studies from Harvard puts out a nice email. It's a great list if you want to get on it. And you can sound smart too when I regurgitate stuff that I don't really know about until I read about it. That's what we're all doing together. We're all learning. I don't know all this stuff. I got to read it. Another new record for renter unaffordability. Okay. So that includes, utilities and rent. So this is a record year. 22 million renter households spent at least 30% of their income. A quarter of renters spend over half on housing. That's humongous. And wage growth is not keeping up with that number. Again, uncertainty. The latest New York Fed survey of consumer finances is slightly worrying as it reports the percentage of households who think they will be unable to meet their debt obligations over the next 3 months is 14%. This is the highest percentage since 16% in May of 2020, right in the middle of the pandemic. So the percentage has steadily risen from a low of 10% in 21 to 12% in 23, now 14%. More households continue to struggle. And, this uncertainty with both, wage growth not keeping up with prices again is sparking some of the uncertainty in the bond market. It's bringing our rates up, and you see the 10-year treasury. Okay, we'll get more certainty. We have more data coming out. We have an election coming. Maybe next month will be a better month. I don't know. GDP is looking to be over 3%. Personal consumption expenditure with those high retail sales is looking to be on track to be at 3.4%, the PCE. I mean, we could see the 10-year treasury go up. So, hey, we're data dependent. Okay, let me switch gears here and just throw in like two things that I thought were interesting and odd. So if you're still with me after the 10-minute mark, the supply chain was the reason why a lot of prices went up during the pandemic. And one thing that was supply constrained was cocoa. So chocolate, the cost of chocolate, okay? So think Hershey's, right? This is not a Hershey's stock tip, although that's where I read it. Again, not a financial advisor. Okay, so did you know that 70% of the world's cocoa comes from Ghana and the Ivory Coast? And they've been having like drought conditions for a couple years. So they're finally getting some rain. And, earlier this year, the projection was for 1.8 million tons of cocoa to come out of Ivory Coast and Ghana. Well, just a few months ago, that estimate was raised to 2 million tons. Well, just this last week, it was raised again to 2.2 million tons of cocoa. So that means prices of chocolate are coming down for the chocolate inputs, which is good. That's deflationary for those of us that are chocolate lovers. Get ready for the holidays. And let's talk about one last thing. It's kind of serious. The BRICS nation, Brazil, Russia, India, China, they hate America from a power perspective. And so, by the way, also I'm throwing in Saudi Arabia in there as well. So South Africa, Saudi Arabia, UAE, Ethiopia, Egypt, Iran, all these new BRICS plus countries are attending this meeting starting tomorrow. And they are continuing to come up with plans to get away from the dollar. Okay, now it's going to take a long time, but they don't, when Russia invaded Ukraine, the U.S., together with some other allies, seized $300 billion of Russian assets through the SWIFT system. The SWIFT system is like the payment rails where, like wires and ACHs and stuff are done all around the world. We've spent decades building the pay rails, the SWIFT system. So the BRICS countries are now starting themselves to start building their own pay rails and their own systems. And so what's one of the things that they could easily trade amongst each other, amongst BRICS countries? They could be trading gold, and they could be buying and selling instantly digitally gold, actual gold reserves, or cryptocurrency, or a BRIC dollar that's a digital dollar, digital currency. And then, of course, over time, if they get enough power, and all those countries who are all quite different and are at war with each other all the time, and sometimes they're friends and sometimes they're not, if they could all get on the same page and create this big giant alliance, maybe they could overtake the dollar as the world reserve currency. Never say never, because every time I do, I'm proven wrong and I've been humbled. Have a wonderful week. I will have one more update on Thursday, and then I'll see everyone in Denver. Cheers. Hey, it's KP coming to you live from my happy place in Corona Del Mar. Some of you have been here with me. We're at CDM Restaurant. It's a place called, can I say the name? Keep it secret? Yeah, we'll keep it secret. All right, you know. I'll give you a little tour. I'm here with my buddy Martin Warren. He's one of the owners of Nations Direct. Yeah, we're chilling. And a lot going on. We're going into the weekend where it is the Mortgage Banker Association annual in Denver. It is like humongous, 3,500 people. So let's get into some news here. What's going on the housing front? What's going on with rates, 10-year treasury, some thoughts. And I will be going crazy next week. Like every minute is jam-packed. If I see you, I'll look you in the eyes, say what's up, and then keep rolling. I've got a lot of meetings. It's crazy. So been booking meetings for like 2 months. Okay. So existing home sales came out, and we know that that's typically the bulk of home sales that get done in a normal year. But this is not a normal year. Rates have been a little high. And so people that are an existing homeowner with a low rate, like at, under 5% or under 4%, certainly around 3%, it's a little harder for them to sell. They're not selling. They're just not selling as much. And existing home sales went down with the data this week. Therefore, new home sales is up because that's all that's selling. Nobody owns it. They don't have to worry about a past mortgage. So that's a big boom for what's going on in the housing world. So I think it's like 780,000 run rate on new homes, and existing was 3.83 million for the year. So we're still short. We're still low. It's normally like around 5 million a year, all in. So next year hopefully will be better. Rates cures everything, and interest rates have been going up since the Fed cut the rate in September by 50 basis points. Interest rates have gone up quite a bit, about 75 basis points actually. I had a meeting today with Tyler Bond from Deep Haven, and we're like, what's going on with rates? Where do you think they'll be? October is a very volatile month typically for capital markets, both equities and bonds. And this is an election year for an October, so it's very volatile. There's a lot of uncertainty. Regardless of what you're reading about the polls and the poly markets and all that stuff, it's still a pretty tight presidential election. And of course, the balance of power in the Senate and Congress is still up in the air. And so that creates some uncertainty, and bond traders demand a higher yield for that. So it's not just about the U.S. Treasuries, though, and mortgage interest rates. There's a lot going on in the world. But over time, it will come out in the wash. And as we get an election, maybe it's contested, maybe it's not. We find out who the president is, who's in control of the Senate and the House. And we go into year end, we have more data coming, and then we go into next year. And then for housing, things pick up, and there's more volume and more mortgage-backed securities being bought. I firmly believe that interest rates will continue to trend lower. They may not go to a crazy level, but where they were in August was pretty damn good. So a 420 yield on the 10-year, look, we compete to sell our treasuries to fund our government, which we have a tremendous amount of deficit spending, and I'll get into that. Before that, let me give you a little look here. Some of you have been here with me. This is a nice little cigar lounge. What's up, Martin? We're just hanging out. Decked out little cigar lounge, CDM restaurant is owned by the same owners as A restaurant, which is phenomenal. Great food. Good little vibe here. We get a full menu up here. Okay, back to business. So the European Central Bank has cut 3 times. The Bank of England is likely to cut. A lot of banks are cutting. China cut. They cut a quarter. In addition, ramming in a bunch of stimulus. So the International Monetary Fund, which is kind of like a global referee, like, hey, this is what we think. They're not always right. They thought the U.S. GDP would only be like 1.8% this year, and obviously we're tracking much higher. But they just came out this week and said that we are the strongest economy in the world, and we will continue to be the strongest economy in the world. So the dollar's been strong, but it took a little breather this week, and maybe we saw the 10-year Treasury also take a little breather today. And so maybe the dollar and the treasuries kind of peaked out. Now it's time to buy some other yielding treasuries around the world to fund their governments. But here's our problem. We spend $1.52 in America for every dollar of taxes collected. So it's like some crazy 124, 127% of GDP. 13% is paid on interest payments. We have to cut. The Fed will cut. They have to cut. They have to cut their way out of this high inflation and high debt payments. They need inflation. They need cheaper dollars, a weaker dollar, to pay off prior debts and treasuries and refunding treasuries and new treasuries with a weaker dollar. And we control the flow of the dollar. And the Fed balance sheet has gone from $9 trillion down to $7 trillion. That's a win. $7 trillion is not a lot in a $30 trillion, $28, $33 trillion economy, depending on whatever it ends up being every year, up from $19 trillion pre-COVID. So, since 2016, again, we spend $1.52 for every dollar of tax collected. And both candidates are saying, hey, let's extend the tax cuts, the Jobs Act. Let's not tax on tips. And it's all highly inflationary. And let's cut taxes for the middle class. So, what's going to happen. The government's saying, hey, if we're going to spend this much per tax dollar collected, you're going to be working a long time. So eventually, one of our biggest fixed payments, obviously Social Security and welfare benefits and Medicare and Medicaid, they're going to raise the retirement age. They have to. They will. That's what every government does. And you know what? We're living longer. And you know what? They're spending more for the taxes that are collected. Let's be honest. We all try not to pay taxes. So they're going to get us back. Trust me, it's coming. I don't know when, but it's coming. There'll be a reckoning. So again, the other economies around the world are not projected by the IMF, the International Monetary Fund, to have as much growth as us this year or next year. So we are the shining star yet again. Speaking of shining stars, the BRIC nations, Brazil, Russia, India, China, and South Africa, they had their meeting in Russia. And you saw the picture there of Modi, Putin, and Xi. You got China, Russia, and India all sitting at the front of the room. You know, China and India don't particularly like each other. Like in the 60s, they had an all-out war. Now, there hasn't been a shot fired since 1975, and they share a border in the Himalayas at 17,000 feet. But in 2020, there was like a hand-to-hand combat fight where people were like, Chinese people were smacking Indian soldiers, Chinese soldiers smacking Indian soldiers with batons wrapped in barbed wire. 20 Indian soldiers were killed. Well, Modi and Xi kind of made up this week, and that could be a threat. Two big powerhouses kind of aligning with each other, that could be a threat. They haven't spoken since 2019. So we're going to keep an eye on those BRICS and BRICS Plus meetings and see where it goes. They're just hedging their bets. India does a good job of kind of dancing that line of being our friend, but also being friends with them. And it's just leverage. But at the end of the day, you know, they're buying gold. They're trying to create their own brick dollar, digital dollar, whereas we have still the U.S. Dollar is the reserve currency of the world. And we have all the payroll systems and everything else. So that will take time to develop. But if we continue to invest in AI and technology and get more productivity from our workers, continue to grow as an economy, and have a no landing where there's no hard landing, no soft landing. We just keep going. There's no landing. The plane just keeps on going. Good GDP, good gross domestic product, good job growth, lowering inflation, which is slowing, which we get the personal consumption expenditure next week, the Fed deflator, the Fed's preferred inflation measure next week. You know, we're just going to keep on rocking here. So what else is going on? It's earnings season. Companies are coming out. Do you know there's 700 million iPhones, which I am not an owner, although an owner of. But by the way, I am not responsible for your losses, only your profits. I'm not a financial advisor. Proud owner of NVIDIA and Google and Apple and Berkshire Hathaway since 2004. Not an iPhone user. You all know you text me and then you stop texting me because I got the Android green bubble. 700 million devices. 700 million iPhones are over 3 years old and cannot get on Apple Intelligence. And so we're coming up, whether it's the Apple 16 or iPhone 16 or iPhone 17, we're coming up on a super cycle where people will start to buy. So Apple looking good. Tesla, 11 billion miles traveled. 9 billion on autopilot, 2 billion on full self-driving. They have eyeballs on the world, and their stock is ripping. Go look at it. 260 today. Nice little pop this week. So we're watching AI right in front of our face. We're watching it take hold. We're watching worker productivity. We're watching our economy dominate in the world. And those are two leading businesses, which we do rely on China. Both those companies get a lot of business from China, but China needs us too. So tremendous amount going on globally, which is why I think the Fed will continue to cut and cut their way out of this inflation environment and our debt and deficit, regardless of what politicians say. And the economy keeps roaring. So that's the breakdown for the week. Next week, again, we're at the NBA Annual. I'll get a Monday night video out from the mean streets of Denver. I think it's supposed to be cold, between the 50s and 30s all week, or at least the last couple days. So everyone, safe travels. Get there and hunker down and let's have a good time. And in this crazy conference travel season, not gonna lie, I'm a little bit over it. All right, have a good one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.